All right, stocks continue their decline from yesterday, so not a dramatic decline. We're not falling off a cliff here, but we're also kind of reversing some of the bullish intermediate run we've been on. So I'm going to break down the signals we've gotten over the last 2 days that kind of confirm this reversal that we've had, and whether or not how significant the reversal will be. Whether it will just be a pullback, if it will be more than that, like in terms of a more of a deeper extended run, maybe even beyond that 4,000 mark. So we're going to break down kind of what we're seeing so far and what we would need to see to get a more sustained decline, and how likely we may be just to bounce right off of where we're at right now and go up. And we'll take a look at some of these signals that would suggest that, and help us in those expectations. We'll take a look at what's driving the price action, some interesting moves here over the last couple of days, some risk-off moves in some areas and not in others. A lot of that has to do with earnings related. We'll break that down. And then our trade idea is a stock that has really kind of broken down way more than what the S&P 500 has, and kind of giving us those signals that we'd be looking for on the S&P. So we'll talk about how to trade its bearish pattern that we see currently. And as always, we're on our trek to get to YouTube 10,000 subscribers on YouTube. So again, we see most of our viewers here are not subscribers that watch our videos. So if you have a minute, just hit that subscribe button down there, and let's help us reach our goal of getting up to 10,000. So let's go ahead and get started. Today is Wednesday, April the 26th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. Hey, before we get going, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. If you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down here to the bottom, click on this heart. It opens up that tab, hit that like button. Same thing here, thumbs up icon, hit that. It opens up this tab eventually, and you'd hit that like button on that tab. There we go, finally, there's that like button. Again, the more you do that, it helps get our content out to our followers on those platforms. That's why we always ask. It's one of the biggest things you can do to help us out. We got up back above 100, so I really appreciate that. Thank you to all those who do click these likes day in and day out. I really appreciate it. And those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's go ahead and take a look at the S&P 500 with the market forecast indicator. And you can see another down day, a couple days in a row now. We've gone from a day ago being at 2.25% above the 30-day moving average, now being, just barely, about as close to being below the moving average as you can possibly be. You got a yellow line. We didn't get the light pink shading, so we don't have the bull tag. The bull tag only comes when the intermediate line's already below 80. It's still at 81. So we're not quite there yet. So we're not, yellow line, but this is kind of the same idea. Now the question, like we talked about over here with the bear tag, is: are we going to follow up on it with some weakness? Or are we going to, mess around and then just bounce right back up, right? Or bounce right back up immediately as of tomorrow. That's the idea. More than likely, it'll be the former. I'm not talking about 100% odds here, but the odds are pretty likely that will continue lower. And the reason being is the near-term line got as low as it did. And you can see it doesn't get this low when you're bullish. It tends to, here it actually got that low in a couple of days. And you can kind of see the rebound it took to avoid the decline. It's not very common when you're bullish to get a near-term line that low and the momentum line to get extremely low. Here, your intermediate line was still kind of rising. We had just barely started the run and then continued it later. But usually by the time you get these really sharp extreme moves in the momentum line, then the oversold moves in the near-term line that coincide with the bull tags, it generally means that you're going to continue lower. So the odds are, again, not 100%, but more likely that we'll continue with this decline. And you'll see some other indicators too here in just a minute why those odds are higher. Here's Dow Jones looking the exact same. It hasn't crossed below its moving average yet, but looks very similar. Your NASDAQ 100 has gotten the bull tag, right? I got it today. We had moved down throughout the day again today. even though it was an up day. So you got a bull tag actually on an up day. But you can see we opened, and then we opened above the line, closed below it, and that's kind of what you need to see to get that tag there and get the yellow, yellow line and the light pink shading. Again, momentum line got to extreme lows yesterday, and then the near term line is dropping down into that oversold level. You can see the intermediate line is actually close on the Nasdaq, closer on the Nasdaq, to crossing below its market sentiment line than the other indexes. And then finally, your Russell 2000, which has been more bearish than all of them, is back to actually dark pink shading and a red line. We had one day of dark green shading and a green line, and then we turned south. Like, we had all these bear tags. We never followed through with them with some more bullishness, like we've talked about before. You get the bear tags, you got to go up immediately and really solidify it. We never did. We just went sideways, got multiple bear tags, never really did solidify it, and now we're rolling over and we're already bearish again. We're already dark pink shading in a red line. You're 2% below the moving average. Bearish short-term sentiment. The intermediate line's turning down from what would be a bearish peak. That would be a very bearish peak there. So the Russell 2000 has been on an intermediate decline, and you could argue that we never did end it. Like, yes, we got a day, just kind of like over here, you had a day of dark green shading in the green line. Your intermediate line actually got into bullish territory, but that really wasn't a bullish intermediate run, and this is basically just a continuation of what we already had into those mid-Junes. And I would say that this is a continuation too. And again, it kind of goes to show, like, since the beginning of March, since basically this financial crisis, we were bearish and we stayed bearish. That's not the same with the S&P, right? And beginning of March, that was what happened. We had a brief intermediate decline. The Russell stayed down, went up a little bit, but you can see the difference, right? The S&P really took off. So a big difference between the S&P and the Russell, and that's showing up there. You can see it too, like when you look at the Fibonacci levels on the S&P, we held resistance again at this 4150 plus or minus area, a few points here. But you have to get below 4,000 before you really start to, like, be on the bearish side of things. The Russell 2000, however, never did get that far. And when you look at its Fibonacci levels, you can see we're already, we fail. Like, there's the 23% Fibonacci level for the correction, right, since it started. You can see that one over here, that line, we never did get above, right, on this whole move higher. We never did get above this 50% retracement of this intermediate run. We never did get above that 23% retracement. We stayed below it, and now we're almost back below. In fact, we are back below the 23% retracement, just barely, of that intermediate rally that we've been retracing across all the indexes, right? The Russell did get above the 78% line briefly, and actually did drop below the 23% line briefly here. So it's been a little bit more volatile than the S&P, which still, it had like one little, that exhaustion gap is all that we got above the 78, and we never did get below the 23. So it's still, we've been months into this retracement of that intermediate run from the Jackson Hole top down to the October CPI report bottom from last year. That's how long we've been retracing on the S&P 500. That's why we don't have a trend, and we can't get when you look at the trend strength indicators for the weekly chart, we don't have a trend, and we haven't had a trend for quite a while. All right, let's take a look at the other weekly that we generally do, and you can see we're back to a red line. We haven't had a red arrow, for a while, which means we're back below the 10-week moving average, or equivalent to the 50-day moving average. You can see that we have a transition candle that is, right now looking like a bearish candle. So when you have transition candles that look like that are, pretty bearish, then now they can lead to more, but you would expect that they'll lead to the reversal. Kind of like this one over here, you can see, and the 12-5 week right here. If you look at the regular candle that week, it was a bearish candle, so it led to more bearishness. So you would expect that would be the case this go around. The Hakinyashi differential has been below its moving average for a while. Now it's below zero. The question is, how deep will it get? The last two didn't get very deep. Got to about 3% was all in terms of the size of the candles. If the candle gets to about 5% move, the size of these bodies gets to about 5%, then that generally means we're going to have more of a pullback than just a normal pullback. That's what we saw for most of last year until those last two decline. So we'll see how big this one gets, if it ultimately gets pretty bearish or not. So if you look at the hull, which sometimes we look at the whole moving average. Similarly, you can see the daily candles, the mark for that one's 2.5%, and we have done that. So we have had two strong bearish candles, and not only were they pretty large, but we closed here below yesterday's low. So the Hakinyashi close was below yesterday's low point, the regular low point. So that's how bearish we are right now. And you can see, of course, bearish candles. The PPO is falling here. We're below the 200-day moving average by 0.4%. 200-day hull moving average. We got the red hull that's falling. You have the parabolic SAR. So we are definitely bearish on that line. If you look at the 3 green arrow chart, obviously we have the 3 red arrows. We had that yesterday on the Russell. So it's 2 days in a row now, 3 red arrows on the Russell. We finally have 3 red arrows on the Qs. We actually got that yesterday, and then today is still holding, because even though we rallied today on the Qs, we stayed below the moving average. And then now we have 3 red arrows just barely on the S&P 500. So now it's a matter of, okay, when we get these 3 red arrows, do we bounce or do we keep going right on the Russell? The Russell looks like it's going to keep going. I expect that the S&P and the Qs will keep going too, and your Dow's not quite there yet. If we can only stay for a day or two and we can get a green arrow again, boom, we're fine. We're great. It's probably not going to be on the MACD, so if you're going to get the green arrow, that means we got to jump right back off this moving average. And maybe the stochastics will probably be your second green arrow. So if we can get those in the next day or two, then I think we'll be better. We'll be able to avoid any, this will be a bounce instead of more of a decline. Again, less likely that will be the scenarios. You can see the RSI dipped below 150. So it dipped below 0, but it's now confirmed it with a move below 150. You are below 50 on the RSI. It's got to get below 40 to confirm that one. So we're not quite there yet. I remember the Russell has been a little bit more bearish. It did drop below 40, and we are below 150 easy on the CCI. So we are in bearish territory on the Russell 2000 across those indicators. Look at the DMI, and you can see the negative indicators is close to crossing above 25. That would start the bearish trend. We are below 20. That's the other half. So you are below 20 there. So that you're halfway to the beginning of a bearish trend on the DMI. You can see that on the Russell 2000, we are above 25 and well below 20 on the. We've been below 20 on the positive, but now we're well above 25 on the negative. And the ADX was below 10. So we were so sideways that we're set up for a kind of a squeeze type move, a breakout type move, and it appears that that's what we're getting here. Looking at the Ichimoku cloud, the S&P is still positive. We're still above the cloud. We're still above that blue line. The rate of change is still positive. You still have a weak trend, even if it's not very strong. At least it's weak. Obviously not the case in the Russell. You're well below the cloud. You have a negative rate of change now here, just barely, but you have a negative rate of change. You had a bearish trend. We're trendless as we speak, but we are back below the blue line, and we are back we're still below the cloud. So you can see, again, you would expect that the S&P is probably going to follow suit, as you see, like we have broken below 40 now on the stochastics, so we're in the bearish range of the last 4 weeks. That 4-week range has been really small. In fact, you can see the range drop to a low point there that we haven't seen in a very, very long time. You can see way over here, last November, coming off the Thanksgiving low point, was the last time we had the 4-week range be that tight. And it's going to actually get tighter unless we get a new low point below here. This low already is showing that what we just saw is based off a low point here. After tomorrow, it's going to be up here, so it's really going to drop again. So that's, you can kind of see, like, we've been filling in gaps. We filled in that gap now. We already filled in that gap over here. Now we filled in this gap. This gap, haven't finished filling in yet. And then, of course, that gap is going to be there for one more day. You can see we're below the value area the last 4 weeks. So we are in, we had a lower high, lower low. We're below the low point. We're below the chart's midpoint. And practically every day but the first 3 days of the past 4 weeks have been above this midpoint. So it's been a really, really tight range. that will get tighter, like I said, and we are set up for a bearish breakout of that really tight range because the red line got to 0 and now the green line is below 70. So we are set up for a bearish breakout there on that chart as well. You can see the breadth is really bearish. We have the McClellan oscillator easily below 35 now. The McClellan summation index is rolling over from what would be a bearish peak, especially if we confirm it below 0 here eventually. So that's a bearish level. Looking at the new highs and the new lows, we are easily below the moving average. It's rolling over. I mean, minus 440. I mean, the breadth is really, really bad right now, and you can see that in the skew had spiked up. It's now dropping back down, as close to dropping below its moving average, and you can see the PPO is turning down. That's bearish. That generally is weak for equity. So a lot of bearish indicators from all sorts of different types of indicators showing up, as suggesting that we're not going to necessarily just bounce right off of this. It was a smaller range today. Yesterday was a bigger range. We dropped back down below average today at 4 points, and the volume also dropped back below average just barely. So after a day of having above average ranges and volumes yesterday, and really, really small ranges in volumes too, average volumes, we dropped back down today. So, again, more than likely, if this is going to turn into something more, it's going to be pretty bearish, because you can see how low. I mean, you saw how low the 4-week range got. You saw how low the ADX got on the DMI indicator. You can see how low this is. The average ATR, again, it got to its lowest point since way back over here in November, right? The last time we were near 1% was coming off of that Thanksgiving low point. So we are extremely low in multiple ways. I didn't show you the Bollinger Bands. The Bollinger Bandwidth is also extremely low. We are in the lowest quartile now. Now, we didn't break below 0, which usually starts the trend, but we are obviously in the lowest quartile. We got the red dot over here, which means that the bands have moved inside the Keltners, which the red dots are what generally signal a change in trend. And we've been bullish. You can see we've been losing the bullish momentum. Now you're going to expect to see some bearish momentum come out of these red dots. And then obviously the green dots again, which would mean the bands have expanded back out of the Keltner channels. You can see lots of examples there. If you look at the volatility index, you can see that the VIX did rise, had a big range today and kind of ultimately ended up flat. The correlation with the VVIX has been improving, though it's still negative. So again, it's still at levels that you would expect a bullish move on volatility, and again, that continues to be the case. You can see we're not even above 90% level, so we're not even nearly at bearish levels from a sentiment standpoint yet on volatility. And you can see too that we are still well below average values on the VIX. Like we're above the 17-day. It's the first time we've been above the 17-day for a while, but we are above the 17-day. You can see the MACD and stochastics rising, but until you break above 20, which is now where the 30 and 50-day average values are, that's when you really will start to pick up the pace in volatility. And again, you would expect that would be the case if we are going to continue to move lower, and that would be the expected direction right now. Unless we get a dramatic improvement tomorrow, that would be the expected direction going into the end of the week and next week, right? When we fall, we don't go down every day, but the rallies probably won't be enough to change the bearish sentiment and momentum that appears to be gaining ground right now, gaining some speed and gaining ground right now. I did want to show one more thing on the breadth. Let's go to the number of stocks here that are below their 50-day moving average. This is by 5% or more. You can see we have now jumped above the mean, so that's a significant break that generally leads, you can see, to more bearishness when you get above the mean. If you take a look at the average price of the S&P stock, is actually more than 1% below the 50-day moving average. Obviously you can see generally leads to more bearishness as well. And then finally, the number of stocks that are above their 50-day moving average at all, even by a little bit, is down to 40%. So we were flirting with the 60% mark, but it acted as resistance. And now we're down to below 40. So just like that, the breath has really turned sour, and that generally will lead to more weakness. I have one more chart I forgot to show here as well that we generally look at is the money flow, and the money flow is still holding up pretty well. That's the one benefit we have here is we haven't dropped below 50 yet on the money flow, and this basically normalizes the volume for the price. So you can see we've kind of broken below like these levels on price, but we haven't on the money flow. So that's actually a relatively good sign. That has not been the case in the past where we've dropped down pretty quickly on the money flow, even though like we're still kind of holding up. So for example here you can see we were higher lows from the end of the year to that March low point, but the money flow went to lower lows. So that's the fact that we are still up above those lows, the fact that we are actually still above this low point on the money flow is the one positive sign. So that means the volume on the decline so far hasn't been that significant. It hasn't been, at least we haven't really had good bullish volume either, but it hasn't been significant enough on the downside. Now that's the S&P, the IWM's a little different in that regard. It actually is down, but again, you can see it has a little bit of ways to go, and it is below 50 on its money flow index here. All right, so one small little positive. I don't think it's enough, but at least it's something there. If you take a look at how the asset classes have performed today, so let's take a look at, let's go to today first. So we'll go to the 26th there. You can see the Qs, thanks to those earnings reports, were the big performers. If it wasn't for the Qs, I mean, we'd be down a lot more than just 0.5%. IWM is down 1%. Commodities are down 1.5%. So risk appetite in general. Emerging markets also were able to hold up today, so that was a good thing. If you take a look at the major countries out there, let's see here, the 12 grid for all the major economies across the globe. You can see I have them ranked in size. China is actually up today, as you can see. Japan and Europe starting to roll over. Not very much. Canada is really falling the most, and Brazil is down slightly below its moving average. Korea is down below its, emerging markets had the bigger declines here recently. So not surprised. It's not a surprise to see that emerging markets kind of held up today simply because it had lost the most. So in the last little bit, right, just the last little bit. If I were to go back to the last 2 days, like when this, for the 2% decline over the last 2 days on the S&P, you can see the safety trade, right? Bonds are up, the dollar's up, gold's up. They're all the safety trades are up. Emerging markets, IWM is down, commodities were down. Like I said, emerging markets were down yesterday going into today, and then they rallied a little bit there. So big move in risk appetite. I saw somebody on Twitter, I can't remember who it was now, that mentioned the Dow Jones Transports Index. No, it's actually DJT, sorry. Here we go. The transportation average, you can kind of see it has broken to new lows. It failed at the point of control. It failed at the 50-day. In 2 days, you can see how big that decline is. Remember, this is the idea behind Andrew Thrasher's report. Now, he didn't do it specifically on the transports, but it's the idea of how quickly you can drop in an index like this. Obviously, an individual stock can change relatively quickly, but when you have an index like this that's dropping as fast as it is in a matter of 2 days, so let's go 2 days here and here, and apply that, and then you can see DJT. Again, that's the biggest decline we've seen in a while. In fact, it's the biggest 7% here is your biggest 2-day decline since May of last year, when we were kind of breaking through this low point here, and we basically were sustaining that decline. And then before that, you can see it's been a while, right? I mean, that's how significant this decline is. We'd have to go all the way back to this decline over here that set a low point coming off of COVID, and then obviously the beginnings of COVID we started with that kind of a drop below prior lows. So, I mean, that's not the best sign that to see that index dropping as much as it is. So, a pretty significant decline, and you're below the point of control. You're breaking, towards the bottom of the value area. You can see you're breaking below the 30-week moving average again after failing with a big gap in volume, potentially to where we fall below the 200-week moving average. So, when you look at some of the other kind of there's some other ratios here that I look at that I pointed out to you before, like lumber this is copper versus gold. You can see how bearish. So this is just barely starting today, in the after hours here. So this big black or red candle is today's move, and I mean that's a pretty big drop on copper relative to gold. We've been on a pretty bearish trend, so we've been diverging with the S&P, and the long-term PPO is falling. If I were to zoom out so you can get some perspective on that long-term PPO there, you can see how it's just falling and potentially going down to new lower lows. So that's pretty significant, that ratio. And then when you look at lumber versus gold, which is another risk appetite ratio, you can see the bearish trend it's on, and it's also threatening to break down to new lows as well, right? And it's already broken below this year's lows, and the PPO is already really significantly down. I mean, this is very, very bearish. You have to go back quite a bit to see levels that are as low as this. If I were to go all the way back 20 years to a weekly chart, you have to go back to 2011, the credit crisis, where gold was so high and lumber was so low. And we're kind of still coming out of the housing issues that we were having there. But I mean, after a big spike in lumber coming off of COVID, and then kind of a double spike here at the beginning of 2022, the correction and risk appetite brought this down, and it's continued to move down even with equities actually moving up. So pretty bearish. You can see the last few weeks here on that chart. If I were to go back to the daily chart again, you can see just how bearish we've been just here more recently. Look at those candles here. I mean, that's a pretty significant change in direction for a pretty common risk appetite ratio there. Here's another common ratio of risk appetite in discretionary versus staples, and look at the divergence we've had. Like, we're just now rolling back over on this long-term PPO. It's been bearish here for quite a while, coming off of COVID, right, and coming out of the correction, which started again on the Russell 2000 post Thanksgiving. We had a higher high on the S&P, but that same divergence led to more weakness across the broader market. The same thing we're seeing right now, a big divergence here with the S&P moving up during this period, that you would expect will lead to broader more weakness in the broader market, not just here. So a little bit of foretelling, so to speak, in this ratio when you have that divergence as significant as it is there. If you look at the correlation down here of it, you can see the correlation generally tends to be pretty positive, and it's relatively high now over the last 10 days. If I were to change this down here to the last quarter, then you can see now that ratio had really dipped at the end of last year, and the market kind of rallied to catch up. It was more weak, and the market rallied. This rally to catch up to the S&P. There's the negative correlation we got coming out of that Thanksgiving that led to more weakness. And again, now you're down to almost 25%, which is pretty rare to be down this low. And you can see it doesn't stay down this low before turning up. And generally when it turns up, you would expect that they would, especially with, over here, you can see the PPO is pretty low at that point. On this level, the PPO is high at that negative correlation and falling. So you can see kind of why. But now the PPO ratio is peaking and rolling over. So if we're going to turn back up on this ratio, you would expect with this falling that this ratio would come down and the S&P would come down along with it. All right, let's take a look at now how the sectors performed here. So give me 1 second to pull up this sector chart, and we'll pull this one up here, the 12 grid for the different sectors. And again, very similar to those other markets. Again, we got the light green shading, the yellow line, but not light green shading there. But we have pink shading and yellow line just about everywhere else. So I mentioned that this was kind of like a bear tag. Well, everything is getting a bull tag, excuse me. All three of these cyclical areas over here, materials and industrials is now red. Financials is working its way down to potentially, we're at 67 on the intermediate lines rising. You'd expect that won't stay there for long. All the safe haven areas are rolling over. Real estate down as much. So you can see the change in sentiment visually on this chart as you look at the comparison chart here, just for the last couple of days again. So go to 4 and then 25. So this is just the last 2 days, and you can see the earnings announcements helping keep technology afloat. That's all today, right? You can see it was down yesterday, and this is today's move. Staples is still holding up pretty strong as well, especially relative to discretionary, which again is risk off. Utilities was up yesterday along with Staples. It was down today along with healthcare. But your other cyclical areas, industrials, materials, financials, energy, all really these economic growth sensitive. In fact, when you look at the GDP now, talk about growth rate, economic growth expectations, we were just in the middle of, at the end of March, towards the middle to end of March, where, again, we were coming off of the financial crisis and settling down. The GDP was up over 3%, and now the expectations is close to being below 1%. So things are changing pretty dramatically for expectations, and we've already, we've had some pretty good results here in the last 2 quarters, but they've all been temporary factors. But the consumer goods and consumer services has been gradually falling and becoming much less. Man, it's a big chunk of GDP, 70%, and it's been falling and becoming much less of a smaller number than what we've seen aside from that one Q1 2022. So the expectation is we're probably going to get, continue that. And without these other temporary factors like the trade data, which generally is weak, you can see the imports have been positive the last 2. That means we're not importing as much. And then exports is generally negative or positive, and it's been negative, which means we're not exporting very much. And then you look at inventories, which is pretty volatile and temporary. And then you look at fixed investment as part of this too. That's not a good number. And you can see it's already getting worse for the next quarter. So even from an economic growth that's been the thing. It's like, we've been, we've been bearish, but the economy's been holding up. Well, now even it's not really been doing that well. And now it's losing those temporary factors that was making it look as decent as it was, and that's impacting these economic growth sensitive areas that were doing so well themselves during this rally off those late October lows. In fact, if I go all the way back to those late October low points here from October 13th of 2022, if I go all the way back to there, you can see how they had their day in the sun. Financials, industrials, they were doing well. Now technology and this communication services kind of took the baton, and then now they're falling, and all these other areas are really declining and showing not the bearish returns yet, but you can see how they're all falling here. Discretionary, energy, materials, healthcare, real estate, all falling below industrial utilities and staples, right? And that's kind of a shift in risk appetite when that happens. All right, now let's take a look at our trade idea of the day. So let's take a look at Home Depot. Home Depot had a similar decline to the Dow Jones transports, although it's not a transport. But still, you had the bull tag. You had a bear tag that really couldn't extend into a new intermediate trend. It kind of had a little weak one started. The intermediate line got up to the 90th percentile at least. But now but not strong enough for the market sentiment, which was well in the reversal zone here, to change its direction and start to come out of the reversal zone. Short-term sentiment has dipped to extreme lows, again suggesting that we may be bearish for a little longer here. If you look at the weekly chart so far for Home Depot, I know the week's not over, but Similar to what we saw with the S&P, you have a red arrow. You're already in a death cross environment. You have a red arrow, you have a transition candle, the MACD, the PPO is falling, and then you can see the Heikin-Ashi differentials crossing below its moving average. So we're in the midst of a transition, very similar again to the S&P 500. We have 3 red arrows, as you saw. Not surprising, a little bit above average volume on those 3 red arrows. You did dip obviously below the 30-day moving average, but you also crossed below the 17 and the 50 and the point of control all at the same time. So when you look at it on the Bollinger Bands and Keltner channels, you didn't break below the lower band, and the band width, is so extremely low. Let's see, that's on SPY. There it is. It is near its lows for the entire year, and you didn't break below the 0 level, but you are into the lowest quartile with a red dot. Again, very similar to the S&P 500. Look at the RSI and the CCI, and you can see it's making a change towards bearish territory, dropping below 50, dropping below 0. Not quite below, the levels that would solidify that yet, but we're in that direction. You look at the DMI, and you see a big break up above 25 on the negative indicator, dropping back down below the negative indicator, or below 25 on the positive indicator. So you see how we're changing directions there. The Ichimoku cloud, we are below. Remember, we're in the death cross environment, right? We are back below the cloud. We have a negative rate of change again. You can see we had, we never did have a bullish trend developed here, so that's how weak that was. And obviously back below the blue line as well. So I decided on this one I'd be a little bit more aggressive on the bearish trade. So I went out to the 275. Right now, if you look at 1 standard deviation at May expiration is at 263. So I decided instead of going out to the 265, I'd go to the 275 strike. Sell that put, buy the 277.5 put. You can see this is the trade that ultimately went through and during our Market Outlook Live session for about 75 cents there. So position size for a half my normal position because it's a directional speculative trade, and then there's my maximum gain if it ultimately works out. Plenty of room, right? So if it starts to come back a little bit usually after you get a big breakdown, you might get a little bit of a move back up towards the moving averages you broke. In this case, like the 17 days, you're just barely turning over on the MACD and stochastics. But it doesn't have to go down today or tomorrow. I got some wiggle room and still able to get more than a 2-to-1 reward to risk ratio if it ultimately works out. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up a new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going. Again, in between videos. Thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Follow us or join our website at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.